Hello everyone, my name is Kramer Grother. I am the Director of Business Development here at Lone Star Capital. Alongside of me is Rob Beardsley, co-founder and principal of Lone Star Capital. We're here currently at our newest acquisition. It is 3 properties and it is 666 units here in Houston, Texas. Rob, would you like to say anything to start about the properties?
Yeah, absolutely. Super excited to be here. We're currently sitting at the Meritage Apartments, which is 240 units, comprising of the total 666 units in this 3-property portfolio. So we're here sitting in the wine room at this beautiful 2008 vintage property. So we'll go ahead and dive into Meritage first, and then we'll talk about the 2 other properties in the portfolio, Beckley and Highland, a little bit later.
Right, so with that said, Rob, why don't you tell the audience and everyone here kind of about Meritage's first property that we're in currently. What's the story on this one?
Yes, as I mentioned, it's a beautiful 2008 vintage, 240 unit deal here in Houston, kind of close to the Med Center, right south of the Galleria. This deal is a mid-rise property, so it's actually the highest quality construction deal in our portfolio. So super excited to be adding this to the portfolio.
Yeah, so with that said, adding this portfolio, how did you add this portfolio? How did we become the buyer that was selected for this property? Obviously, something this beautiful had to have a ton of suitors. Why don't you tell us about that process, how long it took, maybe some back and forth and some color as it pertains to Meritage?
Yeah, so this property is currently owned by a REIT, Next Point, out of Dallas, and they have owned the property for over 5 years, so it's kind of hit their life cycle for a sale. However, they kind of chose to go to market at a little bit of an inopportune time, and they went out to market in a 4-property portfolio, actually separate from the properties that we're acquiring, Beckley and Highland. So it's actually 2 separate sellers that we're dealing with as far as this portfolio. And so Next Point sold off a few of their assets in that portfolio, and then this was the last one that wasn't selling. And so we hung around the hoop, made multiple offers, stayed in contact, and we were able to get finally the winning bid.
And if I'm not mistaken too, I think there was, at one point, a group that was telling us that they were also looking at this property, maybe perhaps about a year ago or 10 months ago, but it was a little bit higher in price, is that correct?
Yeah, less than a year ago, this property was being looked at to be acquired for $52 million plus, and now we have it under contract for $44 million or $183,000 per unit.
Yeah, and back to the per unit, as you just mentioned, I wanted to kind of segue into that. I think the first thing that you notice right when you pull into the property is, oh my God, this is beautiful core plus vintage or asset, I should say. With that said, what do you think the replication cost would be to rebuild something of this caliber and grade, especially in an environment where inflation's crazy, where supply chain's an issue, with labor market going up, especially in a growth market like Texas? What do you think replication costs would be for something like this?
Yeah, so replacement cost here is about $275,000 per unit. So us being at $183,000 per unit for our basis is well below replacement cost, which for value add properties built in the 80s, that's not uncommon. But for a Class A deal like this, that's extremely rare and just shows that we've got a really great basis here. Another similar point is supply. There's actually nothing under construction as far as multifamily in a 3-mile radius.
Wow, that's awesome, and that's really incredible too, especially a lot of people do say how Texas is being so built right now, so to kind of have that locked up is amazing. With that said as well too, what's the business plan here? What is the goal here? Because obviously I think Lone Star traditionally has done the buy it, fix it, sell it, but I look around here when we were doing this a couple months ago, there really wasn't anything to fix. So can you kind of elaborate as to what the plan is?
Yeah, that's exactly right. I mean, we're sitting here at this beautiful '08 vintage property. We already have granite and stainless steel appliances in the units and has resort style amenities. So this is actually a new strategy for us, which is a affordable strategy where we're placing rent restrictions on the property in exchange for a property tax abatement. So that's really the main essence of the business plan, and that tax abatement allows us to achieve a much higher cap rate on this acquisition than would be possible through a conventional acquisition. And furthermore, because it's a restricted rent play, we don't have to take on the risk of a value add where we're raising rents in hopes of hitting mid-teens returns.
With hitting the mid-teen returns, what is the cash on cash profile for something like this? What is the yield on cost that investors should theoretically expect, should things go to plan?
Yeah, and so another important point to note about this business plan is investors aren't taking a risk here as far as the tax abatement going through.
Okay.
That abatement will be in place prior to closing. So the day we close, the property won't be paying property taxes, and we'll be actually walking in at a 6.1 cap plus.
Wow. And I was going to ask that. So it's a 6.1 cap rate for this property plus walking in. What would it be without the, the ability to put this into the structure? What would that look like should any other group come to acquire something like this?
Yeah, on a conventional basis, this deal is about a mid to high 4 cap. So it shows you that just how accretive the tax exemption is in terms of boosting your NOI going in. Because the rent restrictions are quite modest. We're actually only bringing rents down by about 5% or about $100. And that's in exchange for the 100% tax abatement, which is good for 99 years, and it's transferable. So when we go to sell the property in 5 years' time, the new buyer will actually pay us a higher price based on that higher post-tax exemption NOI.
Interesting, okay. What would you say, with all the great information, is your favorite part about this opportunity? Because this is definitely different than other properties we've bought before, This is definitely something totally different. So what do you like most about this offering?
Well, I think what we've just been discussing as far as this tax exemption strategy is really the heart and soul of this business plan. And the reason why I love it so much is it's defensive while still providing really strong returns. Meaning, like I mentioned before, we don't have to take up a lot of risk as far as doing heavy renovations and re-tenanting the property. We essentially achieve the business plan day one, all the values through the exemption. And that's really valuable in a market like we are in today, which is quite uncertain given interest rate volatility and the potential for a recession.
That's awesome. And what would you tell to investors right now who might be thinking, hey, maybe the Treasury bonds are a better purchase right now with them being north of 4? What would you tell someone who's on the fence, maybe investing, saving their money cash? Why is this the deal for them? Why is this 3-pack? Why is Beckley Highland Meritage the best thing they could do currently in the marketplace?
Yeah, I mean, there's a few reasons. One, we have a very unique strategy here with the tax exemption. And then number two, we have the opportunity to generate 7% plus cash on cash returns, which are tax advantaged, in addition to the potential upside of appreciation because we're targeting a 16% IRR over a 5-year hold period, which is a substantially higher return, obviously, than some alternatives, like you mentioned, Treasury bonds. And in my opinion, I do believe that the structure that we put together here and the long-term debt at a fixed interest rate that we're going to be putting in place all make for a very low-risk deal while still being able to target really attractive returns.
That's amazing. And with that said too, that's awesome. We are in Houston. We are in this part of Texas where we are at hurricane risk. You address the tax component, which is, in Texas, when you think of multifamily, you think of property taxes and insurances. You mentioned obviously the property taxes. Can you touch note on the insurance for this property?
Yeah, so this property is situated in a flood zone, so we'll be acquiring flood insurance for this property, and we also have a master insurance policy for all of our properties in Texas, and we will be we're conservatively underwriting a 30% increase in insurance costs over what is currently being paid for now.
Awesome. And with that mentioned as well too, how did this property do during the last hurricane? I believe the last hurricane that was affected was Hurricane Harvey. How did this property bode during that process?
Yeah, given the quality of construction here with the parking garage underground, none of the units were impacted through Harvey. The underground parking garage did take on water, but there was no damage. Mm-hmm. And since then, the bayou has been expanded, and there has been rain events similar to Harvey since, and there's been no issues.
Gotcha. And obviously, what it is said so many times from an investor side is, location, location, location. What makes this location so amazing and, the properties in this portfolio? Why, I guess, now that we're in Meritage, let's talk about that one. What makes the Meritage location so awesome?
Yeah, so Meritage, where we're sitting at right now, is situated just inside of the 610 loop. So we are just 15 minutes from the Texas Medical Center, Rice University, and downtown Houston. And also we're just about 6 minutes south of the Galleria. So there's a ton of jobs in the area, And this is a commuter submarket. So people live here for the great schools, and they also are proximate to hundreds of thousands of jobs.
Okay, gotcha. And of course, in Houston and anywhere you go, of course, tenants expect to pay the premiums and whatnot. Obviously, this one is under some sort of control, as you mentioned. What are the amenities that this place has to offer in Meritage specifically?
Yeah, it's a beautiful resort-style pool, a great fitness center overlooking that pool. There's a club room on the second floor, which can be rented out actually for parties and things like that. And also, like we said, we're sitting in the wine room here, which is a beautiful place for...
Very fancy.
Yeah, very fancy wine room for residents to come and do conference calls here. So yeah, there's a lot of amenities here at the property.
Speaking of those amenities, Rob, why don't we take a tour through them and see what they have to offer?
Yeah, let's check it out. So here we are in the one-bedroom model apartment here at Meritage. And as you can see, we've got wood flooring, granite stainless steel appliances in the kitchen with a backsplash. Very nice condition, but not super modern or upgraded. And this model apartment is the nicest finish that that Meritage has. And there's actually 101 units that are slightly lower finish, which we're going to update the cabinets and the countertops to bring it up to at least this level. But again, we don't need to completely go all out on the renovations because of the tax exemption program that we're doing, because the focus really is to preserve affordability rather than to raise rents.
Immediately, right, what I saw coming into this was how amazing of an experience that the tenant's gonna have. For instance, you've got a balcony right there, you've got a nice kitchen with awesome countertops. Then you step into the bedroom, it's very spacious, and on top of that as well too, the bathrooms are awesome. Tons of space, you do not feel cramped whatsoever. And additionally as well, you have a washer and dryer, which is just an amazing thing to provide to your tenants as well.
So we're here in the club room, which actually gets rented out for a fee by the residents for special events. And we're just right below the leasing office. And right outside, we've got our resort-style swimming pool. So we're here now in the center courtyard of Meritage Apartments. As you can see, we've got 4 stories above ground and 2 stories of parking below ground. We've got beautiful mid-rise 2008 vintage construction. And then behind us, we've got the resort-style pool.
Yeah, come take a look.
Right now we're heading downstairs to the fitness center, which actually overlooks the pool. It's actually really nice. And the cool part about this fitness center is it actually gets some use by the residents.
One thing I also love about the property as well too, especially when we're in the courtyard, is the really nice greenery and whatnot. You got beautiful trees out here. It very much so feels like it's its own oasis. Now that we've taken a tour of Meritage, why don't you tell us about the other 2 properties in the portfolio?
Yeah, Beckley and Highland are right next to each other, kind of over by Beltway 8 and 290, which has recently, 290 has recently been expanded, that freeway over there, which provides even better access for residents at Beckley and Highland to all the nearby amenities, as well as major employment hubs like the Energy Corridor, kind of in West Houston.
Very cool. Now, how would you, just for the audience, compare Meritage to Beckley and Highland? Because they're definitely different profiles, and it's really cool because a lot of investors can get in all 3 of them, but how would you differentiate the 2?
Yeah, it's a great question, and it is a good point because at the end of the day, they are, even though it's a portfolio, they are slightly different deals. As we mentioned before, different sellers, and while here at Meritage we have beautiful mid-rise 2008 vintage property, Beckley and Highland are actually B-plus assets that are built in 1994 and 1999, and they're more traditional garden-style assets. And the benefit of that actually is it's more of a naturally occurring affordable property where the rents are already in line with the restrictions, so we don't really have to turn over the rents or the tenant base very much to put the property in compliance in order to get the tax abatement.
So would you say that business plan, aside from Meritage, that business plan is more in line of what you've done historically speaking with Lone Star Capital?
Well, yes. In addition to the property tax abatement program that we're pursuing, we're also performing a traditional value-add plan at Beckley and Highland. So we're actually getting a bit of both worlds, where we're able to renovate the unrenovated units because the property is currently about half renovated to a premium quartz and stainless steel finish. So we'll be bringing the unrenovated units up to that uniform finish, so we'll be able to raise rents on those units, particularly the market rate units, and then also at the same time restrict the units based on the AMI restrictions.
Very good. And then what would be the cap rate of Beckley and Highland going into those two properties?
That's going to be somewhere similar to Meritage, somewhere around 6.2.
Very good, okay. Yeah, so what are the specifics to the PFC program that you're switching it into? So obviously there's a lot of value in that. Not everyone can do it. So why don't you elaborate as to what that means and how that obviously affects the investor?
Yeah, so this affordable program is a partnership with a local housing authority here in Texas. And in exchange for providing us the property tax abatement, we are going to be restricting the units based on an AMI, or an area median income. So what that means is 20% of the units are set aside for households that make 60% of the area median income, and then 30% of the units are set aside for households that make 80% of the area median income, with the remaining units available to be rented at market rate with no restrictions.
Awesome. And how did you get this property into contract? Obviously you mentioned how Meritage did, but how did you get Beckley and Highland into contract as well?
Well, I didn't do it all myself. Obviously, we have a really great team at Lone Star, but we were able to convince the seller and provide them certainty of closing on Beckley and Highland via actually a hard earnest money deposit. So while other buyers were a little bit unsure of the current market conditions and weren't willing to put up non-refundable deposit upon going under contract, we were willing to do that. And that's what gave the seller the confidence to award the deal to us at a lower price than where other bids were coming in at. Because at the end of the day, as you know, it's not always price that wins the deal. It's other factors such as your terms and your reputation.
What can you tell us about the location for Beckley and Highland?
So Beckley and Highland is kind of more northwest Houston, and it's right near 290 and the Beltway 8. And it's, again, a more residential, suburban location where people commute to nearby employment centers such as the Galleria and the Energy Corridor, which is the third largest employment center in Houston.
Why don't you tell us about the management side? So here at Lone Star, we have our own in-house property management, Radiance Living. Can you shed some light as to how having in-house property management is crucial, but also how having two properties next door can save a lot of money on a management side?
Yeah, absolutely. Having properties nearby as well as being vertically integrated so that our team is local here and has experience as well as resources that can be shared across the properties is definitely a competitive advantage. But specifically with Beckley and Highland, we have a situation where the two properties are adjacent, totaling 426 units, and that allows us to create some payroll synergies, meaning specifically we actually have some interesting plans to hire we have plans to hire a very experienced property manager to sit at one of the properties, and will be more of like an area manager where they'll cover the entire portfolio of Beckley and Highland together. So we're able to actually level up the personnel and also save money on payroll by having more of an efficient staff on site across the properties.
That's amazing. And will you be hiring any new managers to help the 666 units that are being acquired by Lone Star here for this 3-pack? Can you tell us about that?
Yeah, absolutely. So Lone Star prides itself on having, Radiance Living, Lone Star's in-house management company, of course, prides itself on having very hands-on approach with twice the number of regional managers per the industry standard. So that means we can be twice as hands-on with our portfolio. So with bringing on this portfolio, our corporate team anticipates bringing on another regional manager to oversee our growing portfolio here in Dallas and Houston.
That's amazing. And speaking of units and management, one question that's commonly asked is, what's occupancy like? So with that said, what is occupancy like for Beckley and Highland?
Occupancy is strong, historically speaking, in the mid-90s. So they're stabilized assets that are well performing in a generally strong submarket. So we don't foresee really any issues as far as vacancy across this portfolio.
Thank you for sharing about the occupancy and how the property is performed. Can you explain to us at all what the vision for the property is for the 3-pack or Beckley and Highland or Meritage? What's your plan? I know historically Lone Star has done closer to 3 years, but we have 7-year debt on this property with 5-year yield maintenance, if I'm not mistaken. Do you plan on holding it for 7 years? Do you plan on maybe refining it at the end of that note? What is the grand vision as you see it? What in a perfect world would occur?
So we are underwriting the portfolio, Beckley and Highland, as well as Meritage, on a 5-year hold. So we did that because, like you said, we're acquiring with 7-year fixed rate debt, and there's a reason for that, right? The 7-year debt is conservative, it's long-term, and it's at a fixed rate. So that makes us feel really good about going through what may be a near-term recession, right? So we don't want to plan on being able to quickly go in and out and flip the deal if the market conditions aren't right. So we're really very dependent upon market conditions. We're not just going to sell, we're going to wait for the opportune time to maximize returns for investors. With that being said, what makes us feel really comfortable about that is, again, that long-term fixed rate debt, which is going to allow us to produce stable cash flow. So it's really powerful to have stable cash flow that's growing over time, so that we don't become forced sellers into a bad market.
And speaking of cash flow and whatnot, how can we get such great cash flow? Because when someone looks into the numbers, you can see that we're really leveraged for this property. So how is that even possible as well too?
Really leveraged, but we are using appropriate leverage based on in-place underwriting constraints by Freddie Mac. And so what that all is, the reason for that is because of the tax abatement. Okay. And so the lender is willing to underwrite their lending constraints based on a post-exemption NOI. And so that's what allows us to get 75% leverage, whereas most deals today, because of the low cap rate going in, are getting fixed rate debt at 50, 60% leverage. So that's a huge advantage of this tax exemption strategy, is we're able to get optimal leverage on the portfolio, which not only does it enhance cash on cash returns and total returns, it also enhances tax advantages, right? Because we're putting in less equity for the same amount of tax, for the same amount of depreciation for the portfolio.
And I think you mentioned earlier that we're going in roughly at a 6.2 to 6.3% cap rate. Where do you see the exit cap to be? Because obviously, you make a lot of money when caps shrink. I think you mentioned that cap rates would be closer to high 4s if this was without the PFC plan. So where do you see this property exiting for the 3-pack, and I guess Beckley and Highland here in Meritage? Where do you see the exit cap rate to be?
Yeah, so as you mentioned, we're seeing deals trade today still in the 4 cap range. So we're underwriting a 5% exit cap rate on Meritage, and then a 5.25% exit cap rate on Beckley and Highland, just because Meritage is located in a slightly better area and is newer construction, which is why we're using the slightly lower exit cap rate. But yes, the big question right now in the market is, where are exit caps going? And the answer is nobody knows, right? But when you underwrite a conservative business plan like this, where we can generate strong cash on cash returns, and a 5-year hold, that gives us more comfort with our exit, because we're not banking on near-term appreciation. It's more of a medium to long-term play.
So why are Beckley and Highland the best use someone could put in for money? Why is this the deal that everyone back home needs to invest in?
Well, I really feel extremely strongly about Beckley and Highland in particular in this portfolio. Obviously, Meritage is a beautiful deal and it's a great deal as well, but the sweet spot about Beckley and Highland is that we're able to do a value-add plan and increase rents while at the same time restricting rents and getting the tax exemption. So we're getting the best of both worlds. It's a super accretive strategy, which is allowing us to get even stronger returns than if you were just to have just the value add or just the tax exemption.
Gotcha, that makes sense. And do you forecast or see a world in which we're not going to get market premiums on the units that are not in the restriction? And maybe do you want to elaborate on the process of the restrictions with the PFC program?
Yeah, so with the tax exemption program, we have a year to put the rent roll into compliance. So for the first year of ownership, we'll have to make sure that we're catering 20% of the units to 60% of AMI households, and then 30% of the units to 80% AMI households. And given our analysis of the demographics and in-place rents, we don't think that that's going to be a problem at all.
Got it. Now that we've learned a little bit more about the 2-pack here, Beckley and Highland, the garden-style 90s vintage properties, why don't we go take a look at them? are in the beautiful leasing office in Beckley, which is directly across the street from Highland, the other property in the portfolio as well too.
In this leasing office, we have a fitness center right behind us, and then through these windows, we've got the beautiful resort-style pool, which is a big wow factor for potential residents when they first come into the complex.
We're here currently in the gym of the property, and as you can tell, the leasing center, the pool are amazing, but what's the focus going to be?
Yeah, so because the exteriors and amenities are very strong, the focus of this business plan will be on the interiors. So let's go take a look. So here we are in an example of a partially upgraded unit here at Beckley. As you can see, we have black appliances, Formica countertops, and some upgraded flooring and paint. But with the fully upgraded units, we'll be taking the unit to stainless steel finish with a hard surface countertop and adding backsplash in the kitchen. And what's really exciting about this property is this is a partially upgraded unit, but there's still a handful of units that are in classic condition, which haven't been touched in over 10 years, providing us a huge opportunity to go from white appliances to a fully upgraded stainless steel package, which is getting a nearly $300 rent premium.
First impressions are often so important in the real estate business. When I got to this property, the first thing I thought was how well kept the exterior stucco was, the amazing paint scheme. In addition to that too, the awesome landscaping throughout the property.
And the exciting part is we're able to acquire an institutional quality asset such as this while still delivering really strong returns for investors through our property tax exemption strategy. Let's go inside and take a look at the upgraded unit. So here's an example of a fully upgraded unit with all the modern finishes, including the hard surface countertop, the stainless steel appliances, backsplash in the kitchen, as well as the upgraded cabinet fronts. And this is exactly what residents are demanding for a premium finish, and they're willing to pay a rent premium for it as well.
Another thing to note on this property, in this specific unit as well too, is the extremely high ceilings, as well as the abundance of natural light coming in here as well. It's very homey.
Great, well now that we've checked out the upgraded unit, let's go across the street to Highland and see what we have over there.
We're here now in the Highland leasing office, which is also equally very impressive too.
So what we have here is a 1994 vintage asset with 216 units and a beautiful brick exterior.
Right, now let's take a look at some of the amenities as well as the units.
Sounds good.
So here we have the gym. As you can tell, it's also very nicely upgraded with tons of amenities and various exercises that can be done. Looking over to the resort style pool.
Yeah, as you can see, like Craig mentioned, really strong amenities here. So the main focus at Highland, just as Beckley, are the interior renovations. So let's go take a look at those.
Yeah. Here at Highland, the first impression I got was, of course, it feels extremely safe with the gated outside into the property, as well as the brick aesthetic, the beautiful landscaping as well too. Rob, do you have anything to add to it as well?
Yeah, covered and reserved parking is always a great feature for residents as well as an other income item for the investors.
In regards to the property as well, you can clearly see that the roofs have been very nicely maintained, the chimneys look good, the paint looks solid as well too, which are just really great things to have when you're investing in the property. Now let's go take a look at the units.
So welcome to the model apartment here at Highland. And as you can see, we've got the premium upgrade finish here with the modern gray paint, updated flooring, hard surface counter, stainless steel appliances, and the backsplash in the kitchen.
This is definitely one of those places where a renter would come in here and see the trendy finishes and see themselves wanting to live in due to the upgrades that are made here. As you can tell, you've got crown molding, you've got baseboards, you've got the trendy backsplash. It really is a dream space to live in. You have the dining table space back there, you've got the couch area here. Really lots to love about this opportunity to rent a unit like this.
And so just to reiterate, we have a unique opportunity here at Beckley and Highland to not only upgrade the classic and partially renovated units up to this finish, but we also have the property tax exemption, which is really going to boost NOI and cash flow from day one.
Why is this investment the best place someone could park their money? With inflation kind of crazy, obviously things are scary with, international issues going on. Why is this the best investment anyone could possibly make?
Well, aside from our super unique tax exemption strategy here that we've taken years to develop and lots of relationships over time to build, just taking a step back, I still feel very strongly about real estate with the combination of tax benefits, cash flow, and appreciation is the best place to invest. And in particular with us at Lone Star Capital, I feel that we are a great steward of investor capital because of our transparency and our commitment to quality monthly and quarterly reports, as well as the monthly distributions that begin shortly after the first month of ownership.
Yeah, and what do you see for the future for the next couple of years at Lone Star as we move forward? What is your, obviously as the co-founder and principal, what is your vision for the next 5 years, let's say?
Well, 5 years is a little bit far out, but I know that for the near term, we absolutely want to continue to take advantage of this tax exemption structure that we have cultivated over the last 3 years. So that's going to be a major focus for us as we continue to grow the portfolio in Houston as well as Dallas, which is a newer thing for us. As you know, we're just closed on our first property in Dallas, so really excited to be making a splash into Dallas, hiring the local team there, building out the same success that we've had in Houston over in Dallas. So that I would say that is the next 2-3 year plan.
Rob, you've been in business now for how long with Lone Star?
We started Lone Star 5 years ago.
Okay, and would you say this is the biggest deal you've done yet? A 9-figure acquisition?
Yeah, this portfolio, Meritage, Beckley and Highland, totals $110 million in acquisition volume. So really excited to do our first $100 million deal.
Does it make you nervous kind of going through this, or do you feel confident through the process? How do you feel with how we're positioned right now?
Well, I think you've heard this from a lot of our investors. They've been really pleased to see that our growth has been steady and thoughtful. So we're not growing too quickly. We've been preparing a long time for an opportunity like this. We've taken a run at a few other very large portfolios similar to this, and this is now finally our time.
Rob, you've told us so much about this wonderful investment opportunity during an interesting period in time in history, of course. Is there anything that you might want to add that we haven't gone through yet that you think is important to mention, or just maybe reiterate?
Yeah, well, circling back to the tax exemption strategy here, I do think this is by far the most exciting opportunity, and it may even seem too good to be true when investors take a look at the structure. And with that in mind, there is some potential changes that may be coming to the laws related to this program, but we are being grandfathered into our existing deals. So when these properties close, we'll be grandfathered into the tax abatement structure for 99 years, and no future legislative changes will impact the properties.
Excellent. Well, you've heard a lot of great things here right now. Should you have any questions, reach out to me. I'd be more than happy to help you, accommodate. Obviously, be working alongside Rob, Dasha, and the rest of the team. But if you need anything at all, let us know. Rob, really appreciate you giving us the breakdown here today.
Thank you.